Right, so clearly the timing, I think, of this is very opportune. Nobody knows better than you guys who work at the JSE exactly how turbulent and volatile the last few weeks have been. And so it's worthwhile, I think, maybe to sit back and say, well, how does this affect each of you and me personally in terms of our own investments? You might also find that many of your friends and your family, knowing that you work at the JSE, might be asking you questions about their own personal investments. And as much as you can't give advice, certainly there are, I think, some good guidelines that one can follow. And I'm trying today also to not give you investment advice. I cannot give advice unless I'm actually dealing with an individual and I've got a better idea of your background and your financial position. So this is more factual information and guidelines, ways to think about your investments and trying to focus on the things that we do know and that we can focus on in terms of our investments. So I think from that perspective, sorry, hit the wrong button there. So let's just get onto the correct one. Right. As always, we have to have a disclaimer up front. So, by the way, these slides will be made available for anyone that wants to have them. So you can take notes if you want to, but you're happy to also get the slides and just refer to them after the webinar today. Just some background in terms of myself and where I fit into the industry. Some of you might know me, some of you might not know me, but I do quite a lot of work within the industry and certainly with the JSE as well. So I'm very pleased to be able to spend some time with you this morning as we dig into how do I calm the chaos? How do I sort of get to a point where I feel more comfortable with the very unsettling environment in which we find ourselves? And there's really two things that I want to share with you. The first one is that we can focus on what we know for certain, because there's a lot of things that we don't know for certain, that we don't know at all. A lot of it is projection, speculation, guesstimates, modeling that's being done. But let's focus on what we know for certain to try and help us deal with the chaos that we find around us. And the other thing from a personal perspective is to say, focus on what you can control. When we have got such a chaotic environment, it feels as though we are completely out of control and that we don't have any say or do in terms of how our lives are being led. But there are things that we can control. And if we focus on what we know for certain, and if we focus on what we can control, what I typically find is that leaves a lot less bandwidth, if I may use that analogy, a lot less bandwidth to deal with a lot of the noise that we are hearing, not just around coronavirus and the COVID-19 disease, but certainly also about our investments. Because you probably find yourself at the moment, if not at home, certainly somewhere on the corner of lost, confused, unsure, unclear, perplexed, disoriented, and bewildered. So how will we deal with that? Where you should focus when you don't know where to focus is to focus on what you know. So that's what I'm going to be doing with the next hour with you, is to focus on the things that we know for certain and to focus on the things that we can actually control in terms of it. Because let's just face it, quite frankly, my crystal ball is quite cloudy at the moment. It is not very clear. I don't know if any of you have got a better clear crystal ball, but there's the lovely famous saying that says, it's really tough to make predictions, especially when you've got to go do those about the future. So let's try and rather focus on what do we know. What we certainly know is we know what's happened in the past. I mean, as the JSE and as sources of a lot of good historical information, you know exactly what happened in the past, whether the past was a minute or 5 minutes ago, 5 days ago, 5 years ago, or indeed even 100 years ago. And from that long-term information, we also know that seasonality in markets, bull and bear markets, up and down cycles, corrections, spikes, these are to be expected. So on one point, we need to understand what we shouldn't be all that surprised about what we are experiencing at the moment. This is to be expected. The next thing we also know is that it certainly pays to stay invested during the cycles. The idea that one can try to time markets, and certainly where we are promoting trading strategies, some of that might look very much like we are trying to time the market. But I'm going to be talking here today about investment strategies, not trading strategies. And from an investment perspective, trying to time the market is a fool's game, and it results more often than not in a situation where you end up selling selling low and buying high. So we want to try and avoid that behavioral bias that we as humans have, and try and avoid getting caught into this trap of trying to time the market. But the other thing that we also know for certain is that there are opportunities that allow us to save tax. There's a whole range of incentives that government is offering us from an investment tax savings perspective. And by focusing on those and making sure that we maximize the tax incentives and opportunities that government gives us, certainly is a great way to deal with some of the poor performance that we might be seeing, because on an after-tax basis, if you maximize those tax incentives, you will certainly find that you are much better off than you would have been otherwise. So let's start with the first point. The first point being that we should expect this seasonality of the markets. And I'm just going to share a couple of stats with you. I know most of you are also very analytical and mathematically inclined, so I know that you enjoy stats and graphs and so on. So let's have a look at some of those. So since 1990, over the last 30 years, corrections in markets happen on average about once a year. Now, a correction is defined as a decline of 10% or more, but not more than 20%. So somewhere between 10 and 20%. This is something that happens on average every year. So we should not be surprised to see these sort of moves. But of course, if it goes down by more than 20%, this is what we refer to as a bear market. And when we look at corrections, about 20% of them do turn into bear markets. So if you think about a correction happening once a year, on average it means that we can expect a bear market, in other words, a decline of more than 20%, to happen once every 5 years. So that is actually a lot more frequent than the current environment would make us feel the frequency of this is. And when you look over the very long term, these corrections and these bear markets are often, or the corrections are often, just short breaks in what is really a long-term bull market. And if one sells too quickly out of something like this, it means that you miss out on the upward trends. And we're going to look at some of the stats around that shortly as well. What we also know for sure is that nobody can predict consistently if the market will rise or fall. We are flooded with information flow, news flow about predictions that are being made. And this is quite a nice graph that I saw in terms of some of the predictions that have been made about the sort of decline that we're currently seeing over the last 5, 6, 7 years. So as far back as 2012, there were already predictions. Watch out for a correction or worse. Prepare for a stock market crash in 2013. Doomsday poll, 87% of risk of stock crash by year end, and so it goes on. And it's very easy in where we sit now to say, oh, you see, they were right. But you see, if you responded to those predictions in 2011 or 12 or 13, or even all the way up to 2017, 2018 and 2019, you would have missed out on a lot of the positive performance that was there. And not having that positive performance as a buffer or as a starting point to work from means that the correction, when it comes, hurt you that much more. It really is incredibly difficult to predict the future. The other thing we know for certain is that the market has always risen over the longer term, despite these short-term setbacks that we have. And whether those increases over the longer term are mostly because of inflation. That certainly is a component of it. But the other reason, of course, is that we do find that there is capital growth faster than inflation in your equity markets. And that's why over the long term, you find that your markets will go up despite these short-term setbacks. As I mentioned, historically, bear markets have happened every 3 to 5 years. This is a drop in more than 20%, which is where we find ourselves at the moment. So just to reiterate again, this is not that unusual. The size and the speed of the current fall has certainly been quite unusual, but the fact that the market does go down by more than 20% is not that weird. And ultimately, it is bear markets that turn around to become bull markets. And a lovely quote by Warren Buffett that I'm sure many of you may have heard of: the stock market is a device for transferring money from the impatient to the patient. So patience certainly pays off, and especially the younger you are and the longer your investment horizon, the more you can afford to be patient and allow the market to do its thing. Because quite frankly, the greatest risk is not a correction or a bear market. It feels like that at the moment because that's what we're experiencing at the moment. But that's actually not the greatest risk that's out there. The greatest risk is being out of the market when the market recovers. Let me show you some stats of the S&P 500 over a 20-year period from 1996 to 2015. Over that period, the S&P 500 index gave an average return of 8.2% per annum. So if you were invested in the S&P 500 index for that entire period of time, and you didn't try to time it or sell out and buy back in and so on, you would have achieved 8.2% per annum over that 20-year period. If you were out of the market just for 10 days of that 20-year period, 10 days is nothing, 10 days out of 20 years, your performance would have halved. Just by missing out on those 10 biggest days, your performance halves. And we've seen that. When do we get our biggest positive days? Often after some of the biggest negative days. That's just how percentages work. So not being there, trying to time it and missing that timing means that you lose out. If you're out of it for 20 days, so this is like less than a month out of 20 years, your performance is now a quarter of what it would have been. Excluding the top 30 days, no return, and excluding the top 40 days out of a 20-year period, a negative return, minus 2%. And that just shows you how incredibly important it is to be in the market when it has these bounces. And whether it's a dead cat bounce or whether it is a bear market rally or whatever we want to call it, if we are not in the market for those rallies, we actually end up missing out on a lot of the performance that the market gives us over the longer term. So I'm going to just show you some numbers around what I refer to as Fearful Freddy versus Steady Susie. So who's Fearful Freddy? Fearful Freddy is the guy that sells after every panic. In other words, at the low, after the market has fallen, Fearful Freddy buys. And he says, I'm only going to buy once there's confirmation that things are good again. So after there has been good performance, he buys back into the market. Steady Susie, on the other hand, stays invested through all of this. She continues to invest regularly. In other words, she buys more units. She buys more investments when the market is, I guess, what we can call on sale as it is at the moment. Steady Susie benefits from the compounding also, the rand cost averaging of investing regularly. Plus, she saves on transaction costs and tax because she's not trading all the time. So what does the performance of Fearful Freddy versus Steady Susie look like over time? So Fearful Freddy, if he sells every time after a negative year and buy every time after a positive year, is the gray chart. And you can see that there are times that Fearful Freddy has done better than Steady Susie. Not by much, but a little bit. But when you get to a point where there are these big bounces after a big fall and Fearful Freddy is not in the market, like, for example, in 1998 with the Russian debt crisis, the emerging market debt crisis, or in fact in 2008, you can see how being in the market, yes, Steady Susie lost more, but being in the market when the recovery comes means that she accelerates ahead of Fearful Freddy, and why it is so important for us to stay in the market, to enjoy not just the bad, well, hard to enjoy the bad times, but when the bad times comes, you experience them. But if you stay in the market, it means that you have the opportunity to enjoy the good times when they do come around. What is the other thing that we know for certain? We know that there are ways in which we can save tax. And I think we're all on this bandwagon. We definitely want to save as much tax as possible. So what are the three things that I want to focus on in terms of tax saving strategies? Tax-free investment accounts are the obvious and the most important first choice for everybody, most importantly because you are allowed to have a tax-free investment account for every single family member. Every South African citizen can have a tax-free account. You don't have to be a taxpayer. In other words, a child can also have a tax-free account. These are benefits that are earned at the source, so you don't, the dividend withholding taxes, for example, are not paid away. This has got nothing to do with the tax position of the investment account holder. So you don't have to be an employee or earn a salary and pay tax in order to get the benefit of the tax savings in a tax-free investment account. Of course, if you are employed and you are making contributions to a pension fund, to retirement savings of some sort, this is another way in which there are some significant tax savings to be had, and we're going to go into some detail of these different tax savings shortly. So the contributions to a retirement saving is also something that you can do over and above your own pension fund or provident fund, your occupational one, the one that you would have at work. The third one to look at is the opportunities for tax harvesting. And this does get a little bit more technical, but I'm going to take you through some examples shortly to show you how by locking in capital gains throughout your investment life cycle, you are also able to reduce the tax liability over time. So let's start with the tax-free investment account. What are the benefits of the tax-free investment account? Well, it really is that it is no tax whatsoever. No capital gains tax, no dividend tax, withholding taxes, no interest taxes. And also there is no restriction on withdrawals from a tax-free investment account, neither the timing nor the amount that you can withdraw. Having said that, however, the fact that we are allowed to withdraw does not mean that that is a good idea, and we're going to come back to this point later on again. But so you can withdraw money if you can, but you certainly should not be using your tax-free account as an emergency fund or a short-term savings account. The most benefit in a tax-free account is accrued over the very long term when you get significant capital gains in that portfolio on which you will not be taxed. What are the disadvantages of tax-free investment accounts? Well, it's such a good deal that they have to limit both the annual as well as the lifetime contributions that you can make to tax-free accounts. Annual limits currently 36,000 Rand per person per tax year. Lifetime contribution limits 500,000 Rand. That's neither here nor there at this stage, because 500,000 Rand is going to take you somewhere between 13 to 15 years to build up, depending on when you started. So we are not going to reach the 500,000 Rand limit for at least another 10 years from now. So not something that we should be concerned about. Really focus on that 36,000 Rand annual contribution limit that is currently in play for every tax year. So from the 1st of March until the 28th of February next year, 36,000 Rand per person. There are also restrictions on what underlying investments you can use. For example, unit trusts with performance fees are not allowable investments for tax-free investment accounts. Same applies to ETFs, and ETFs, although they've got no performance fees, ETFs have to be classified as unit trusts. In other words, they have to be registered as a CIS, a collective investment scheme, with the Financial Sector Conduct Authority. But from a stock market perspective, the only things, in other words, that you can buy into a tax-free investment account would be ETFs that are also classified as and registered as CISs, as unit trusts. And the good news is that there's almost 70 of those available on the JSE, covering a very broad range of asset classes and geographies and investment strategies and a whole lot of different things. So I don't really see this as a disadvantage. An important point that I want to share, because you might hear that some people talk about a tax-free savings account, and here I'm talking about a tax-free investment account. The tax-free account is still the same tax-protected sort of wrapper or structure that we're talking about, but the big difference is what is the underlying asset that you hold in the tax-free account. In the case of a tax-free savings account, it's essentially something that you do with a bank, and the only thing that you can earn from that is interest. And therefore, the only thing that you can get tax-free is interest. But as it stands, we all already qualify for 23,800 Rand of interest per year that we can earn tax-free. So wasting is how I refer to it, wasting your tax-free allowance, the only 36,000 Rand that you've got available to use in a tax-free account, wasting that on a savings account really is a waste, because it means you don't get the opportunity to get dividend, to save on dividend withholding tax, and there's no capital gains to be had, so you also forfeit or lose that opportunity. So very important to use your tax-free allowance for an investment account rather than for a savings account, despite the fact, and I know a lot of people will say to you, but over the last 5 years, cash has outperformed everything. It's been much better. Yes, performance-wise over the last 5 years, bank accounts, savings accounts have certainly outperformed most of your equity investments over this period of time. But if you look at the amount of tax that you save, you'll appreciate that an investment account certainly trumps a savings account in this period. What about retirement annuity funds? Now, those of you working full-time at the JSE would be a member of the Occupational Pension Provident Fund that you've got at the JSE, but a retirement fund is like a personal pension fund or a personal retirement savings fund, something that is in your own name and it belongs to you and you take it with you wherever you go, meaning that, if you were to leave the employ of the JSE, you would have to have your provident or pension fund of the JSE transferred to the next employer, whereas the retirement annuity fund will just remain your own. And the savings, the benefits that we get from this, as much as you know it with your pension or provident fund, two big benefits from a tax perspective is that there is no tax payable inside the fund. In other words, the assets that are held inside a retirement fund or a pension fund or a provident fund, there are no capital gains tax payable inside the fund. There's no dividend withholding tax, no interest tax, those same benefits that we just saw now. But the other benefit is that there is tax deductibility of the contributions that you make. Basically, any money that you contribute to retirement savings, so that is a combination of what you pay to your pension or provident fund or contributions that you make to your retirement annuity, those are all tax deductible, meaning that you don't pay personal income tax on those. Yes, there are limits. The limits are 27.5% of your taxable income every tax year, or 350,000 Rand per tax year, whichever of those two are the smaller of the two amounts. Again, we're going to go into some examples of this in a bit, so just to take you through some of the numbers. The disadvantages of retirement savings is that you are not allowed to access this until the age of 55. Those special circumstances are things like, for example, immigration and so on, but for all intents and purposes, money in a retirement annuity fund is not available to you until the age of 55. Also, there are restrictions on the underlying investments. This is referred to as Regulation 28 of the Pension Funds Act. And Regulation 28 imposes limits such as, for example, that you're not allowed to invest more than 30% of your assets offshore outside of South Africa. You're not allowed to have more than 75% of your exposure in equities. And there's a couple of other restrictions as well. So for many people, these restrictions feel too prohibitive and they don't want to be subjected to these restrictions. But maybe a little bit like the lockdown restrictions, we need to focus on the benefits that we get from the lockdown. In other words, so the tax deductibility of the contributions in the case of an RA fund, rather than focusing on the disadvantages that come with being Regulation 28. Another important one to note also is that money that sits in a retirement annuity fund is protected from your creditors. Nobody can actually take the money that is sitting in your retirement savings, so that's quite a good protection. And it also falls outside of your estate, meaning that there is no estate duty or inheritance taxes payable on retirement savings. So as much as there might be disadvantages to it, and a lot of people feel quite negative about retirement funds, retirement annuity funds, it's worthwhile to focus on some of these positives or some of these benefits that are to be had, and not throw the baby out with the bathwater and say, I'm not going to make contributions because it's not worth it. So let me show you why I do believe that it is worth it making some of these contributions. And it's one of my favorite little tricks that I show people, and that is, how do I get SARS to pay for my investments? Now that sounds like it's too good to be true, but for once, this is actually possible. So let me take you through an example. If you are on a taxable income of 430,000 Rand per annum, in other words, we're looking at round about, how much is that? That is about 36,000 Rand per month. Taxable income of 430,000 Rand per annum. If you make no retirement savings contribution, it means that your taxable income is the full 430,000 Rand. So all of that is going to get taxed. The tax that you would be paying on that 430,000 Rand is just short of 86,000 Rand of tax that you would be paying, and your net income, therefore, just over 344,000 Rand for the year. But what if I make the maximum retirement savings contribution that I'm allowed to make, which is 27.5% of my taxable income? So that would be a contribution of 118,250 Rand, which is then fully tax deductible, meaning that my taxable income is only 311,750 Rand. So that's the amount of money on which I will be paying tax. And the amount of tax that is therefore payable is quite a bit less than 50,000 Rand tax that I have to pay. My net income, 262,125 Rand, understanding, of course, that I've already made a contribution of 118,000 Rand to my retirement savings. This means that the tax that I've saved in this scenario is 36,000 Rand, 36,165 Rand. Now, that amount sounds very familiar to me. Does it maybe sound like something that you could go and stick in your tax-free investment account? So this is a way that by making a contribution to retirement savings, if you use the tax that you save by making that contribution, you are really leveraging the amount of investments that you can afford to make from your finite taxable income of 430,000 Rand. Now, I fully appreciate that this is quite a tall order, to pay away 27.5% of your taxable income to retirement savings. For many of you might seem a bridge too far, but I think it is certainly a worthwhile target. It is something worthwhile looking at, and we're going to talk about the differences in priorities depending on your age and your tax position that you find yourself in. We're going to go into that in a bit more detail shortly, but I think the principle is what is sound here that I wanted to share with you, is that by making contributions to retirement savings, you are able to save tax now, right now, upfront, your personal income tax, which is then something which can boost other investments like tax-free investments that you're able to do. What about tax harvesting? What does this term really mean? So tax harvesting is really about locking in the capital gains that we are allowed to have tax-free every year. Currently, 40,000 Rand of capital gains every year is something that we can actually lock in and not have to pay tax on that. So one can, for example, use capital losses in your portfolio. We might find at the moment that that's the case for many of us. Lock in some of those capital losses to offset capital gains elsewhere, but you can also use this opportunity, therefore, to rebalance or to restructure your portfolio without incurring any taxes. And this is quite a healthy sort of exercise to do at least once a year. The disadvantages is that capital gains only become relevant after 3 years. Prior to that, if one is going to be buying and selling quite frequently, SARS will view that as income and tax you as income rather than as capital gains. But if this is something that is being done by an asset manager on your behalf, maybe in your unit trust or whatever, then it certainly counts as capital gains. Of course, this would also incur some transaction costs, so we want to make sure that we minimize the amount of trading that we're doing and also make sure that the amount of tax that we save in this way justifies the transaction costs that we incur. It is also an opportunity for you to switch to lower cost investments. So you could, for example, find that there are ETFs that you can buy that give you the same type of asset class exposure as some of the unit trust investments that you might currently have. And here is an opportunity for you to switch to something that has the same exposure but with a much lower cost, and therefore helping you, assisting you quite a lot in terms of your after cost returns over the lifetime of your investments. So let's look at an example of such a tax harvesting exercise. Let's say that you start off by investing 250,000 Rand, meaning that your base cost is now 250,000 Rand. After 3 years, if the investment has grown to 300,000 Rand, it means that the capital gains that you now have is 50,000 Rand. And the maximum amount of capital gains tax that you could be expected to pay on that would be 9,000 Rand. But if you were to lock in 40,000 Rand of those 50,000 capital gains, and you would do that by selling 80% of the investment. So how do I get to 80%? Well, it's the 40,000 Rand of tax-free capital gains that I'm allowed to have, divided by the 50,000 Rand of capital gain that I have in the portfolio. That is 80% of my portfolio. In other words, I would be selling 240,000 Rand worth of investment That's 80% of 300,000. And I immediately reinvest it. So that's a very important one to remember. This is not about selling low and buying high or locking in losses or anything. This is about selling out at a level where your capital gains, where you're locking in those capital gains and immediately reinvesting it. So your new base cost now would be just 20% of that original 250,000 that you invested, plus the new 240,000 that you invest. So now your base cost is 290,000 Rand, meaning that your new capital gain, now that you've locked in some of those, is only 10,000 Rand, on which the maximum capital gains tax that you would be paying is just 1,800 Rand. And you can see how by applying this principle as part of your regular sort of annual portfolio review and doing some tax harvesting like this can save you capital gains tax over the lifetime of your investment. And is certainly a great way for you to also just lock in some of those profits for your own benefit rather than paying too much of it away to SARS and to the taxman. So let's quickly talk about the second part, which is about focusing on what we can control. We've spoken about focusing on what we know for certain. How do we focus on what we can control? And there's this lovely little picture that looks at the things that matter and the things that you can control, and you'll see that there's a relatively small overlap. And those are the things, within that overlap is the things that you should be focusing on. One could argue at the moment that certainly the COVID-19 pandemic and infection rates and so on is things that matter, but it's not something that we can control other than doing what we are doing now, which is being in lockdown and social distancing. But from an investment perspective, what can we control in terms of this? And I'm going to talk about 3 C's. The first C is the C of costs. You can control to a large degree the amount of money, the costs that you spend in terms of your investments. These costs could be anything from the total expense ratio of the fund in which you invest in. It can be the brokerage rate that you've got to pay when you buy ETFs or shares on the stock market. It could be the administration charges that you've got to pay for your investments. It could be the advice fees that you have to pay. There's a whole range of different fees and costs that one needs to incur in investments, and some of those are definitely within your control. So this is a good time to really sort of take out the magnifying glass and say, what costs am I actually paying for my investments, and which of those are costs that I can actually reduce or remove completely if needs be. So costs is our first C that we can control. The second C is the contributions that you make. The money that you invest on a regular basis, or how much money you put into the market, your regular contributions to your pension or provident fund or your retirement annuity fund, regular contributions to your tax-free investment account, maybe regular savings into an emergency fund or into a discretionary portfolio that you've got. You choose when you put money in. That's within your control. And in times like this, when we are fearful and when there is so much chaos, there is the tendency not to want to put in contributions because of the past performance. But you can continue to make those contributions, and as we discussed, it's by making those regular contributions that you get the long-term benefit of rand cost averaging, of buying some investments now while the market is on sale. So remember, how much you put into your investments is within your control. And the third one, which ties into that really, is about consistency, how regularly you do this. There's obviously a lot of people at the moment that are looking at, should I be investing now? Should I get back into the market now? Is now a good time? And that talks to the idea of the contributions. And we're going to talk about how to make those decisions a bit later on as well. But in terms of consistency, this really talks to the power of that habit of making contributions to investments every single month. Just like you brush your teeth every day, just like you shower, just like you eat every day, the consistency of that is incredibly important to our financial health. And having a regular investment plan as part of your monthly expenses is incredibly important. You can control that, and with that you can really also help a lot in terms of the success that your investment strategy comes down to. But I would promise that I would come back to, so if you are now an individual investor, what should you do first? We've been speaking here about tax-free accounts. We've been speaking about retirement annuity, discretionary portfolios. Where do you even start with that? So before you even consider to make your first investment, the first thing that you have to do is to make sure that you've got your consumer debt under control. With consumer debt, I'm referring to possibly credit card debt that you might have, store cards, clothing accounts, anything that is of a relatively short-term nature in terms of when and how you can use it. Consumer debt is not your mortgage, your bond on your house that you own. To a lesser extent also even your car repayments, although that one gets a little bit borderline. It's often can be quite an expensive debt to have. So we're really focusing here on the short-term consumer debt, overdraft facilities, credit card debt, store cards, clothing, furniture stores. Those you've got to get that under control, because effectively you are paying away the interest rate that you pay on those debt is effectively the return that you could have earned that you are paying away, that you're getting rid of out of your life. So you've got to get your consumer debt under control. The second important part is to make sure that you've got an emergency fund in place. And I think for many people, the current crisis has really just sort of highlighted why it's so incredibly important to have an emergency fund. 3 to 6 months is often advisable for people that do have full-time jobs and with a reasonable prospect that they would keep their jobs. I've seen some people saying, you know what, considering the experience that we've just gone through now, maybe having up to 12 months of income as in an emergency fund is not a bad call. It's difficult to do that in one go, so this must be a target, a goal that you work towards to actually build up money towards an emergency fund. And once you've got those two things well underway, then we can start looking at investing. And now the question would be, well, where do I start? Which one must I do first? And so, yes, we said the emergency fund because you know what, that is part of your investment. Your emergency fund is something that's going to be sitting in a high-yielding savings account. I would not recommend a fixed deposit, because an emergency fund is something that you need when there is an emergency. Then you can't be giving notice on a 12-month fixed deposit. So there are a couple of our banks that are offering quite good interest rates on savings accounts. Have a look at those and keep your emergency fund in there. The second focus then is to say, maximize my tax-free investments, that $36,000 per annum per person. So if you're part of a family, if you've got a spouse or if you've got a partner, children, whatever, this is certainly something that you can do for everyone in your family. And remember, we said we want to focus on an investment account, not a savings account. But resist the temptation to draw money early from a tax-free account. This must not be your emergency savings fund. You don't want to lose that contribution that you've made and not be allowed to put it back in again. So don't put money into a tax-free account which you are planning to use for your child's school fees next year, for example, or for that overseas trip that you're going to do as soon as the travel ban and the travel restrictions are lifted. The other thing to focus on is then to optimize retirement contributions. We mentioned up to 27.5%. But this is something that, and only once you've maximized those tax-free opportunities, only then should you start thinking about discretionary investments. So I so often see people starting out with that stock portfolio, the share portfolio, the online share trading account, really wanting to get into the excitement of trading. And they've done that, but have left a whole lot of tax benefits on the table because they wanted the excitement of the trading rather than the certainty of the tax savings that is there. And maybe, again, after what we've just gone through over the last couple of weeks, I think it'll be easier for people to see that the excitement of a roller coaster, such as the market, has got the ups and the downs, and maybe it's worthwhile to first focus on locking in the things that we know for certain before we start focusing on discretionary investments. Discretionary investments, well, you know what, it could be the stock market, ETFs, it could be direct property. It's definitely not Forex. Forex is not an investment. I just want to make that clear. So focusing on what we know for sure, if we say we want to maximize our tax savings, which two should you go for first? Should you go for the tax-free investment or should you go for the retirement annuity? And there are really two important criteria that help us to decide which one is the top priority. It is your age and it is the current tax status. In other words, how much personal income tax are you currently paying? So how do we prioritize? And note my note at the bottom there that says, I'm now assuming that you already have your 3 to 6 month emergency fund in place and you've got your consumer debt under control. So if you are currently younger than 40 years old, in other words, you have at least 15 years until the 55-year age limit where you would be allowed to access your RA fund. So if you're younger than 40 years, or you do not currently pay a lot of income tax. So if you're a relatively low earner and therefore the amount of personal income tax that you pay is not that high, then your first priority is definitely to maximize your tax-free investment account. The second one would then be to maximize the retirement savings contributions. And the reason why that is secondary for me to the tax-free one is because your amount of tax that you can save by making contributions to retirement savings is less if you are not currently paying a lot of income tax or if you are still relatively young. The discretionary investments, as I say, is always our third priority in terms of it. But what if you are older than 40? Or you currently pay a lot of income tax. So you might be younger than 40, but you're actually already in quite a high income tax bracket and paying a lot of tax. Well, in this case, we actually swap those two around. So then we would first focus on maximizing retirement savings contributions and then maximizing the tax-free investments. Listen, ultimately, the ideal is to be able to do both. But just in order of priority, this is how I would guide you to make the decision around the priorities of what you're doing. Once again, your regular or discretionary investments is the last priority in terms of all of this. But, you know, we put together these beautiful plans and somehow we see this as if it's this beautiful straight line path towards our goal. And despite the fact that we know that there's going to be ups and downs, with the way that we plan, and especially when we do sort of these annual numbers and forecasted numbers, it seems as though everything is plain sailing in front of us. Whereas the reality that we've just seen over the last few weeks is much more like the second graph, the one that really shows you the extent to which there are problems along the way, that there are mishaps along the way. And yet, if one can manage your investments through these uncertain times, through these turbulent times, the goal that you ultimately reach is much better than the one in that theoretical original plan. So talking about investment strategies during times of market crises, I'm just going to give you some guidelines around your three different main sort of investment types: your retirement savings, your tax-free investments, and your discretionary investments, because those three all have different priorities also and strategies that one should employ around it. So in terms of your retirement savings, when we look at that, the most important question to ask yourself is, what is the time to your retirement date? Now, that might be how far are you away from the age of 55, but your retirement date might also be 60 or 65 or whatever you intend to be your retirement date. Look at how far you are away from your intended retirement date. If it is less than 5 years, then it would be in your interest to start switching some of your retirement funds into cash. I say some of it because there's no need to switch more than 1/3 of your retirement funds into cash. The balance of it should still be in medium to high risk investments. And the reason why I say that is when you retire, you are not allowed to withdraw more than 1/3 of your retirement funds at the time. You're going to be paying tax on it as well, but yes, you are allowed to take up to 1/3 of your retirement funds into cash. The balance of your retirement fund, the other 2/3, will still be invested after you retire to sustain you through retirement, and those would still be in medium to high risk investments. So by de-risking your portfolio now, only to go and re-risk it again when you retire, really also is quite a short-term view. So you want to remain invested for at least 2/3 of your portfolio. If you are more than 5 years away from your intended retirement date, then you really should not be doing anything to your retirement savings. Your retirement funds would also be invested, whether it's a pension or provident fund or a retirement annuity fund. These are not investments that you manage yourself. They are overseen and managed by an investment manager, a portfolio manager, who will do the best that they can in terms of dealing with the uncertainty and the volatility. There is no doubt that when we see our pension fund or provident fund or RA fund statements now for the end of March for the current quarter, they are going to look horrific. So be prepared for that. Expect to see that your pension, your retirement savings have declined probably by at least 20%. It might even be more. It might be 25 to 5%. So be ready for that. Expect that, but don't make that the trigger to make you do something with it. To now suddenly go and want to withdraw or sell or switch things or so on. Do nothing. You've got to remain. This is where the steady Susie comes in really handy, to remain invested in a high risk portfolio, to catch all and every one of the up days as they come, and they will most definitely come. Also important, continue to make your regular contributions. We spoke about the consistency of those contributions, because again, you're also saving that upfront personal income tax, something that you know for certain that you can deal with. This is maybe an opportunity also, especially when it is an RA fund. So obviously you can't change anything about your occupational pension or provident fund, but when it comes to an RA fund, this would be a good opportunity for you to consider switching to a low-cost fund, especially if you're currently invested in one of those old generation high-cost RA funds, and where they are allowed to even penalize you for switching. Those penalties are typically based on as a percentage of the value of the portfolio. So this is a great time after it's fallen 20 or 25 or 30%. Switch now, because that will actually allow you to pay much lower penalty than you would otherwise. But other than that, don't do anything with your retirement savings. What about your discretionary investments? Let's talk about those of you that already have current investments, that already have an investment portfolio of some sort. The first thing is that you should not be selling anything just because the market has fallen. There might be other reasons of why it is good to sell, but these not because the market has fallen. You certainly don't want to be locking in at the lows. This is a good opportunity for you to review what you currently hold and to say, is what I have in my portfolio, does it actually serve my needs? Does it fit my investment objectives? And this is an opportunity for you to sell out of things that are inappropriate, that are wrong, that are too high cost, or that have got the wrong type of exposure for your strategy. This is a good time to sell out of that, but very importantly, and that's why it's in bold and red, immediately reinvest. This is not about selling low and buying high. This is about selling low and buying low. You want to buy at the same low level, but you're now going to be owning, after you've sold and bought, you're going to be owning something which is a lot more appropriate for your investment strategy. We spoke about the tax harvesting opportunities, and this is a time where you can look at some of those opportunities. Again, locking in some lower levels of capital gains tax. If you're sitting on a portfolio that you've had for a long time that had a lot of capital gains in it, here's an opportunity for you to lock in some of those lower levels of capital gains tax and immediately reinvest. You could also, especially where you are maybe selling something which is in a loss now, which doesn't feel like that's the right thing to do, bear in mind that capital losses can be carried forward from one tax year to the next. Capital gains not. You pay tax immediately on it, but capital losses can be carried forward. So don't be too scared to take capital losses now to get out of something that is not serving you, that is not a good investment for you, and use that to offset future capital gains in later years when things look better. Again, very importantly, immediately reinvest. What about new investments? Should you be making new investments at this stage? Well, the first rule is definitely that your regular contributions, you want to continue with that. Again, that consistency that comes through. And my recommendation around any new contributions that you are making, use this as an opportunity to start gradually shifting your portfolio, changing your portfolio exposure to the preferred exposure that you've got. If you've decided that what you have at the moment is really not serving your investment needs well. What about your tax-free investments? Well, as I said, tax-free investments have got the longest investment horizon. And this is something that we want to leave for as long as possible to give us the maximum capital gains. So this one really is the one where you don't want to do anything. But most importantly, do not withdraw. Do not take money out of your tax-free account, because it will affect your lifetime contribution limits and you can't get that back. So as far as current tax-free investments that you might have, Same principles as we discussed with discretionary investments, the same applies. This is also an opportunity for you, maybe if you are currently in a tax-free savings account, to switch to a tax-free investment account, because you're allowed to do that. This is not seen as a withdrawal. This is a transfer of an existing tax-free account from one provider to another. So now is a great time to be doing that, because it means that you can buy into these investments at a much lower level after the market has declined. What about new investments? So you certainly want to continue making your regular contributions. Remember, 3,000 Rand a month will take you up to the 36,000 Rand per annum that you're allowed to do. And as before, use these new contributions to shift the portfolio exposure to your preferred exposure. And what are the preferred exposures in a tax-free account? Well, anything that is high yielding, so things that pay high dividends or interest, like preference shares, bonds, property, or the dividend-paying ETFs, for example, or something that has a high capital growth potential. Might not feel like it at the moment, but we do know that equities, and especially our global and offshore ETFs, over the long term has got the highest capital growth potential, and that's what we want to focus on. So I have had so many people asking me this question that says, I have money available now. Is this a good time to buy? Should I be buying? Well, quite frankly, who knows? Nobody knows. Nobody knows what the market is going to look like tomorrow, next week, next month. We just don't know. Quite frankly, unlike the opening bell ceremony that we've got there at the JSE, nobody's going to ring a bell and tell you now's the time to get into the market. Now's the bottom. Now you've got to get in there. So it isn't possible to time your entry into the market. So the question I ask myself, or suggest that you ask yourself to decide whether now is a good time to buy, is ask yourself, is your fear of loss greater than your fear of missing out? Your fear of loss is the fear that the market falls another 10 or 20 or 30% from where we are now. The fear of missing out is that the market rallies from here and you haven't invested. So which of those two sits better with you? Which of those do you think is the least of the two fears for you? If your fear of loss is greater, if that's the biggest fear that you've got, then don't invest everything. Split your investment, do it in 2, 3, 4 tranches, decide over what period and what portions you're going to be investing in the market. Split it in to get some Rand cost averaging over time. But if you are not that fearful of losing further, and if your fear of missing out, if you've got serious #FOMO, then you know what? Just invest now. Just do it. Just get in there, and don't then tomorrow, if it does fall, blame yourself. Maintain your long-term investment horizon that you've got. This brings us to some opportunities for questions, and I see I do have some questions already that have been posed. Let me just see if I can increase the size of it a little bit, because at the moment, I see one of the questions this morning, will you be sharing the slides with us? Yes, indeed. The staff at the JSE already has got the slides, and very happy for them to send this through to everybody that was registered and on the call, so no problem with that. Another question that I have from Itabile that says, can an individual have more than one tax-free investment account, or is there a limit? No, you can absolutely have more than one investment account, a tax-free account. The important thing to check is that your total contributions over the year is not more than the 36,000 Rand. But you're certainly allowed to have more than one account. Just bear in mind also that the account providers will not be able to help you check whether you have made too many contributions, because they don't know. They only know what you contributed on their side. So you would have to check for yourself what the 36,000, how far you are or how close you are to your 36,000 limit. Just want to see if there's anything else. There's another question here. Hi, Nerina, you showed 20 years of S&P 500, but this feels more like a 1929 depression type of market. Do you have info on that period? Unfortunately, not readily available, and I agree with you that it does feel as though we are much more in a 1929 environment than, say, a 2008. I think the main difference really for me would be that what we've experienced in the last 15 or 20 years in markets have been mostly financial market crises, and therefore the responses from the Federal Reserve, for example, central banks around the world, to make a lot more money, a lot more cash, a lot more liquidity available, that have been quite effective in getting the markets to recover quite quickly, and that's where that classic sort of V-shaped recovery comes from. In the case of like a 1929 post the Great Depression and so on, it was much more of an economic scenario. And that's where I agree with you that I'm concerned that we are currently don't really have a good sight of what the impact of the current pandemic is going to have on global economic growth. We know we will definitely have a global recession this year. There's no doubt about that. But is it going to be just for these first 2 quarters of the year and then the economy recovers quite quickly? Or is this going to have a much longer tail to it? Who knows? I don't know. And I think that's where this dichotomy or this concern comes in. Do I invest now and because we're going to have a recovery, or do I not invest because we're going to have another 20 or 30% down? I just don't know. We need time to actually give us more clarity in terms of what's going to happen in terms of it. But those for me would be the two big differences between, let's call it a 2008 or even a 1998 type of financial market crisis that we had compared to the 1929 to 33 period, which was very much an economic crisis globally. So